All right. Good afternoon, everyone. Thank you for joining us today. Today is May 2nd, 2023. Welcome to our recap from the month of April of the commercial real estate capital markets. My name is Huber Bongelin, and I serve as StackSource's Director of Capital Markets. I'm joined today with my co host, Chris Peters, who serves as StackSource's Director of Inbound Lead Originations. We're going to start with and get into what's new and notable in the markets for the month of April. So, to start, I'll pass it over to my teammate Chris to brief us on some news and events from last month.
Great, thanks, Huber. Good afternoon, everybody. Good to see everybody. A couple high-level, noteworthy pieces of news this past month: institutional sponsors defaults. Blackstone, Brookfield, and other institutional owners are facing loan defaults on office and multifamily properties in New York, LA, Chicago, and several other major markets around the country. Something to definitely keep an eye on as the years and quarter plays out. Um, 74% drop in multifamily sales. Obviously, we're all feeling the lack of transaction volume and size and quantity of deals that are closing. This has been pretty significant. It's not only been felt in multifamily, but it's also in office, retail, industrial. So we're definitely seeing a slowdown in sales activity. Um, Most recently, over this past weekend, First Republic Bank failed, the second largest bank failure in history. First Republic was seized by J.P. Morgan, seized by the government, and then sold to J.P. Morgan over the weekend. And then lastly, rates. Rates have been coming down. They peaked in sort of the October, November of 2022, and we've seen them come down pretty significantly. Rates were down even further today. So that's definitely something we're going to keep an eye on. And Huber, I know you've been monitoring rates, so we'll dig further into the rates.
Awesome. So on this slide here, you guys may remember it from last month. So every single month, we're trying to keep track of how rates are changing, inflation is changing, as well as treasuries are changing here. So one of the welcome signs is that inflation continues to fall and continues to drop. You see that trend over the last couple of months, it falling down here. And as long-term rates, if you look at the treasuries in 2 years, yes, it has been increasing, but this graph shows it over the last year to 2 years. One of the things that Chris had just mentioned in the last slide is if you take a peek at the right side, that last quarter, that last 2 months of data, you're starting to see the 10-year treasury as well as the 2-year treasuries start to, it looks like, top out and decrease and lower. So we're hoping that as things begin to move forward and progress in the year, that rates continue to tick downward. Here you'll see our slide on current commercial mortgage rates. While there are always exceptions to the rules, here we've shown in the different rows the different types of lenders that StackSource we are tracking daily. And on the right side, you kind of see the upper bound and the lower bound of where rates are today per lender type. So, of course, there may be exceptions to the rule. There could be an incredibly hot lender that is giving an interest rate that may be lower than this, or maybe vice versa, someone that's ultra conservative and has a higher rate. But as far as what we're tracking right now, here's where the typical lower and upper bounds are for rates today based on the type of lender that you're approaching for financing.
Yeah, and Huber, that sort of leads us into our first bullet point here, where we're seeing a really wide range of quoted interest rates. We're taking the same deals out. I'm sure other folks are experiencing this. Taking the same deal out to a wide array of lenders and really getting back a pretty significant um, wide range in rates. You might bring a deal out and get something in the high fives, low sixes, and bring it out to a similar lender and get something in the mid to high sevens. This is really reflective of lenders' appetite for risk, how they typically price out a deal, potentially different leverage points or other factors that go into pricing a deal. But definitely seeing a wide range and really it's advantageous to bring deals to as many lenders as possible. Secondly, yeah, we're definitely seeing banks and credit unions tighten and or pause their either new originations, or when they're underwriting a deal, becoming a lot more conservative. Obviously, to the first page that we mentioned, bank failures. I don't think this is sort of a 1, 2, 3 and done for 2023. We're definitely going to see some more activity with banks around the country. And lenders are going to be focusing on high quality deals, high quality sponsors, strong markets, potentially reining in leverage just to keep things more conservative as they do underwrite deals. Lastly, one thing we're definitely noticing is it's sort of two-part. We're noticing folks become a little bit more conservative in the cap stack, right? So senior lenders might be historically at 70, 75% loan to value or loan to cost. We're seeing them reduce their leverage to 60, 65%. And this is really allowing for other folks to come into the cap stack, such as LP equity shifting into a pref piece, right? Moving lower into the cap stack, becoming a little bit more conservative, a little bit safer in that part of the stack. There's other mezz and other players that we can certainly bring into the stack, and we're seeing it. But overall, we're definitely seeing lenders and investors just become a little bit more conservative.
Sure, absolutely. Just adding on to that last part, I'm seeing it too with certain lenders and when they get more conservative, more structured financing, where you'll have to find those pref equity pieces or those mezzanine debt pieces to fill those extra layers of the stack. So very interesting to see that these people that used to be very comfortable in a more limited partner equity position, wanting to take a more secured spot in that pref equity or mezzanine debt piece. Nice. So looking into the months ahead, one is the first bullet point here, bad is good to now bad is bad. What does that mean? Well, historically, I would say over the past maybe end of last year, first quarter of this year, if we were to get bad news, we actually said, hey, that could be a good thing because maybe the Federal Reserve will start tapering and will start lowering rates. Maybe they will pause, they will hit the pause button on their amount of increases. So that is the first part where initially, maybe last quarter of last year, if there was bad news, we would indirectly think, that might be good for us. But now you're starting to hear the sentiment and seeing it more and more, especially in the news. I'm sure we're all feeling it, getting peppered with it in our inboxes. Bad news is now actually just bad news. The bad news we don't know what it'll lead to. Will it lead to a deeper recession? Will it lead to decreased property values, more economic turmoil, more job losses? How will Federal Reserve, Treasury, these institutions that we have in place, how will they react to all of these bad news? These are things that we will be continuing to watch in the months ahead. Some of the news that we're starting to see now, the cracks that we're starting to see now that will play out, and again, we're watching for the months ahead, are defaults, fire sales, and workouts. There's slated to be about 270 billion of loans maturing this year. So in these challenging markets, the question to ask is, what do you do when your loan matures? We know that we have higher financing costs. That is making it harder for owners to refinance. These may lead, not necessarily will lead, but may lead to increased activity in defaults, fire sales, and workouts. Some of the things that I'm sure we're all seeing again hitting our news inboxes, office assets. We're seeing them in big cities, whether it be San Francisco, my hometown, Los Angeles, or New York City, and even Seattle. These office assets are posing the greatest risks. I think I saw recently a CoStar metric that office vacancy is about 16% nationwide. So, of course, that'll vary city to city, whether you're in a major downtown area or a suburb. But overall, that vacancy is at 16% and seems to be creeping up. So, what is the hope? The hope is that if investors, one is being able to refinance or sell successfully. But if not, then if it does lead to some type of loan default, that these loans will be able to be restructured. There will be some type of extension in order to prevent a foreclosure or a fire sale. And then lastly, you see here that last debt is floating rate debt refinances. So investors with floating rate debt that they may have got into 2 years ago or 3 years ago that are coming due, We talked about that wall to maturities. I'm sure you've all seen it. What are they going to do now with the potential to refinance? But those refinances are looking at rates maybe 3 to 5 times higher than what they were expecting. So, what are the solutions for some floating rate debt that are coming due? So, those are some of the things that we're tracking in those months ahead. But StackSource is absolutely here to help. So, to tell you about us, I'll pass it back over to Chris.
Awesome. Thanks, Huber. Yeah, for those of you that don't know us or need a quick refresher, we're a group of expert capital advisors sourcing debt and equity across the country. We work with about 1,000 unique capital sources, banks, credit unions, life co, debt funds, private equity, family offices. Um, we've closed about $1.5 billion of financing across 45 states. We really do pride ourselves on being transparent, both in our process as well as when we work with lenders, providing full transparency. So if you guys have any questions on our business or what we do, please don't hesitate to reach out. Right now, we will kick it over and look at some questions that are coming in from some of you folks. There is you can always reach us at hello@stacksource.com or go right to our website at www.stacksource.com, and we'll look at some questions to get us started. Let's see here. Okay. All right. First question. What are some of the challenges associated, this goes right to your last point. What are some of the challenges associated with floating rate debt refinances, and how can commercial real estate investors prepare for them? Huber, I can start it, and then
Sure.
Feel free to chime in. Yeah, it's a tricky environment with floating rate debt. We've seen, prime go from 3.5 to 8, potentially 8.25 tomorrow if they do end up raising rates. We've seen LIBOR or now SOFR jump 400 or 500 basis points. So it's really difficult. Obviously, we're hearing cash in refinance, and I think we've talked about that a couple months in a row now. Yeah, it's definitely challenging. People, investors and advisors have to get creative on how to sort of recreate a capital stack when it's time to refinance or restructure a deal. So I think getting creative, finding alternative sources of capital to fit into the stack, because right now senior debt may not cut it. And if you're refinancing out of a bridge or construction loan and you are projecting certain amount of rent increases or certain amount of value creation and it's not there, yeah, you really do have to get creative.
Sure. And jumping in that last part of how can commercial real estate investors prepare for them for these maturities. A couple of things that I'm seeing. One is lenders being more open to what we call bridge to bridge financing. So let's
Yeah.
say you're in this floating rate bridge debt scenario, your loan's coming due, and you've tried to get perm financing, but those rates are just too high for you for right now to digest. There's kind of two options here that I've seen be successful. One is there are you fully stabilized, or are you still stabilizing and you need more time, or maybe there was a certain cost that you think could yield more rent premiums for yourself? Finding another lender that would be a bridge takeout. We're starting to see more lenders being open to bridge, and that could buy you another 1 to 2 years of interest only payments as you wait for markets to stabilize. That's one potential option. Another one that I've seen is if your deal does pencil, but yes, it is a higher rate, but your deal does pencil and you're able to get that perm takeout, then one thing to look for and to negotiate is a soft to no prepay penalty. So the reason to negotiate for that is when and hopefully rates start to come down, start to stabilize, start to bring them down, then you're in a position where if you have a soft or no prepay, you could seek a refinance with that current lender, going back to them, or searching back around and bringing your deal back out to market, and you won't be penalized with a stiff prepayment penalty, whether it be step down or defeasance or some type of minimum yield, right? Trying hard now to negotiate for those soft or no prepays could be another strategy that you take if you're in a floating rate debt scenario and you're
Yeah.
trying to refi into a perm situation.
Yeah, good point, Huber. And one thing, it's sort of funny to hear from lenders, but we're hearing if you get a deal, take a deal, right? Because that deal may not be there tomorrow or the next day when you're trying to improve certain terms. So, in this environment where even getting a deal is challenging, if you do have one in hand, it probably makes sense to take a deal, and then sort of regroup and figure out how to get a better deal 6, 12 months down the road.
Nice.
Um,
Excellent.
Moving on to the second question, how does the trend of investors seeking safe havens lower in the capital stack impact the types of deals that are currently available in the commercial real estate market?
Nice. So we touched on that earlier with maybe players that used to be very comfortable being in an LP equity position, wanting more of a pref equity position. I would say the answer to this is maybe more structured financing. Like the deal is just because maybe you go out for a perm senior loan and you needed 75%, which was stomachable maybe a year ago. Now they're down to maybe six. If they were down to 65, and oh my gosh, where's that 10% going to come from? I'm stuck now. It's not over. There are pref equity players or mezzanine debt players. So I think that this trend of investors seeking safer havens, even if your senior loan was now lower, allowing for only lower leverage, you could still fill that in with different parts of the capital stack, whether that be pref equity or mezzanine debt. Or even if you're in a construction financing, we're seeing a lot of deals include or consider including CPACE, which is
Yeah.
another form of gap financing, a little bit more structured. But we're happy to tell you more about CPACE if that's something you're interested in. Just reach out. But we're starting to see these other kind of lenders come in and being able to fill in the gap.
Yeah, and I think one thing to add there, lenders that aren't beholden to regulators or audits, or the extent of audits that a bank or credit union might have, they've got a lot more flexibility on what they can do, who they can work with. So, looking at private lenders or debt funds that might have an opportunistic bucket, just as Huber said, and can maybe do a senior loan and mezz or pref or something, something unique and structured that gets the deal done and sort of moves the investor on to the next phase is something we're definitely seeing. All right, let's see other questions coming in here. What are some of the key factors that commercial real estate investors should consider when assessing the risks of default, fire sales, and workouts? I think I can start this, Huber.
Sure.
Communication is key, right? If you are an investor and you have a loan coming due, or you're tripping certain covenants, communication with your lender is key, right? If you've been sort of hiding and don't want to have the tough conversation of, where are we at? How are we going to pay our debt service? It's going to be a tough discussion when you actually do meet with your lender. But in our experience, keeping lines of communication open and having discussions, being sort of open and honest with your lender can go a long way, right? A lot of these lenders don't want to foreclose on a property. They don't want to have to take that property out to market and sell it. They're not in that business, right? So having open lines of communication, figuring out a way to find a solution that is amicable to both the lender and the investor, is ideal, right? Nobody wants to be in the situation when they get themselves into it, but as long as you're communicating with your lender or the other investors in the deal, that really does go a long way.
Chris, I think you nailed it. I'm in that situation right now with one of my clients where I'm helping them through a
Yeah.
workout situation. And that communication is key, especially knowing your timing of when things are happening. When it comes to that, check your loan docs over. What happened with the timing here? How would these things work out? Maybe you want to engage legal just to make sure that you're understanding the timing of processes correctly. But the lender, for most part, does not want to take the property back. Usually they're not in the business of owning property, they're in the business of financing. So trying to find a way, as Chris said, having open communication, trying to find a way for a solution that works for both parties, that's going to be ideal as everyone works through these next couple of months.
Awesome. Looks like we have time for one more question. This one is back to rates. How do the recent changes in interest rates impact the underwriting and deal structures of commercial real estate loans?
Sure. I'll jump in on that one, Chris, and then yeah, if you have more to
Yeah,
that for that one, it depends on your time, right? If you're looking at the trend, that longer term trend where rates are higher now, then of course it's going to have a constraint on your DCR, on your debt service coverage, right there, and that might have to be a negotiation with the lender or with a new lender if you're seeking new financing. Um, I think that's the hardest one is the DCR ratio is getting that pulled back in. But if you're looking at over just the past 30 days, 60 days, as you had mentioned, Chris, in your slide earlier about how it's gone down, some of the treasuries have gone down the past couple. Then if that trend continues, that should be a bright sign for a lot of our investors. That should make it easier for people to refinance and get the proceeds that they need if that trend continues of rates going down.
yeah, and I think the only thing to add there is from a lender standpoint, it's just understanding what the risks are and how they price a deal, right?
Yeah,
3 6 months ago, you know, there was a lot of scary noise out there, and inflation was still increasing, and we were sort of starting out the upward trend in short-term rates. So there was just a lot of unknown. I think the more that lenders get comfortable with the risks and they sort of understand where the market's at, there'll be that spread that we mentioned earlier, that wide range between lenders. That's just, in my opinion, that's just a function of different risk tolerances and sort of
sure.
not knowing where we're at. I think as more comes to light, and we figure out the real direction of inflation, and how high we need to increase rates or how long we need to keep them at this level to really bring down inflation. The more we know, I think the easier the financing side will be, and we'll get more intel from our lenders.
Nice. Absolutely.
Um, all right. Well, that concludes our capital markets update for the month. Again, if you guys have any questions, please reach out to us, hello@stacksource.com or www.stacksource.com. Huber, as always, a pleasure. And we'll see
Absolutely.
everybody.
Thank you, Chris, and thank you everyone for joining today. And we look forward, again, reach out. Here's our information on the screen. Anytime, any questions, we're here to help, right? It's a trying time, but we're here to help. And we have a lot of experts on our side, a big team that can help out with any of the issues that you might be dealing with today. So with that, we're looking forward to seeing everyone at our next recap a month from now. Thanks, everyone.
Thank you.